Hello and welcome to a new series called Global Equity Income Insights. My name is Alan Breen, Senior Investment Manager with Cantor Fitzgerald Ireland. And I'm delighted to be joined by Leo Mazza, a Junior Fund Manager with the GEI Fund. The first episode is the power of dividends against inflation. Leo, we're now experiencing another new normal where we've a period of rising inflation and high interest rates. Where do you see opportunity?
Yeah, so as you said, we're now experiencing a new normal, and we can also say that the era of free money is over. Now people need to adapt to a new macroeconomic environment, which is unfamiliar and characterized by high inflation and high interest rates. These levels of inflation were last seen more than 40 years ago. And by just looking at historical evidence, we know that when inflation rises above 5%, it might take up to a decade before it goes back to the 2% target rate. Just to make a few examples, in Ireland, it took 13 years in the 1980s and 9 years in the 2000s. Or in the US, for example, it took 6 years in the 1980s and 8 years in the 1990s, which isn't necessarily bad news, but it means that you can't leave your money in the bank anymore. You have to be invested, and let me add, you have to do it wisely, because this market environment requires high flexibility and proactivity.
It's different to the last, most recent time where you were allowed to leave your funds in a bank because you were charged for the privilege. So it's an interesting dynamic shift. For other reasons now, you're forced out the risk curve to some extent. So Leo, typically, clients would see dividend stocks as old, static, more boring stocks. Is that the case, or would you see significant opportunity at the moment?
Yeah, people usually think of dividend payers as static and old businesses with little room for expansion, but by their nature, dividend strategies invest in established businesses that generate significant amount of free cash flows and typically do better in inflationary times than those that are more growth focused. The most common question that we get is, are dividends a relevant source of long-term return? And my answer is yes, dividends are extremely relevant. Since the 1930s, for example, dividends have contributed about 40% of the Standard & Poor total returns, but when inflation was above 5%, which is to say in the 1940s, 70s, or 80s, for example, dividends were responsible for 54% of the total returns.
So perhaps you could give us an example of the difference between a typical dividend paying stock and a stock that doesn't pay a dividend, so be on a different stage in its life cycle, so to speak.
Yeah, so what really matters when you're selecting dividend paying companies is focusing on the right dividend yield. We don't want companies with an irrelevant yield because it's too low, but we also don't want companies with an excessively high dividend yield. If you think about a high yield, let's say, for example, above 6%, I agree that it looks extremely attractive, but it might be a sign of vulnerability. It could be the result of a stock sell-off. And of course, that implies uncertainty about the future payouts. The most attractive opportunities in terms of risk-adjusted returns can be found in the middle of the dividend yield leaderboard, which is also where the volatility is the lowest.
So if you look at the market currently, given the world we're in, I guess, where you might have a stock that has a growth expectation of say 10%, you factor in inflation at circa 6%, and the actual reality of growth. So if you can find a steady company with strong income and good dividends, it takes a lot of risk, so to speak, out of the equity component in your portfolio.
Exactly, that's absolutely true, because a popular belief is that commodities are great inflation hedges, but that's very, very generic. The reality is that commodities, if kept as inflation hedges, are not a reliable source of long-term returns, but dividends are. Dividend strategies are a great source of long-term returns. The reason is that dividends keep up with inflation, reduce portfolio risk, negate potential losses, and enhance the total returns. So our Global Equity Income Fund reflects all these features, and the strategy is pretty straightforward. We invest in a diversified global portfolio of financially strong companies that are well managed, and they have a track record of paying and attracting dividend yield, but also they grow that dividend over time.
Leo, thank you so much. In the interest of time, we'll wrap it up there, but I look forward to speaking to you again at our next presentation. I would invite you all to check out the Cantor Fitzgerald website for more information on the GEI funds. Thank you for joining us today.
Thank you.